My friends, what is going on? So this video is going to be about covered calls. Okay, I thought about doing a whole new video on kind of the entire wheel strategy, but people are asking me the most consistently about how I play covered calls, and so this video is going to be detailing what's going on, a little bit about what a covered call is. If you haven't watched I think the video is titled Think Like a Market Maker. I go back through and do a very elementary explaining, if you will, of exactly what a covered call is. So I'm not going to talk too much about that. I'll go over the basics. But this video is going to be more about how I played it. The specific one I'm going to go over this week is going to be BBIG. So, and also too, if you want to see how I kind of played my AMC ones this week, please go and watch the most recent AMC video that I did, and you'll be able to see when I opened up my covered calls for AMC. So first things first, if you guys are new to the channel, please like and subscribe, share, tell your buddies about it, all that good stuff. And as always, I'm not a financial advisor. Everything I'm doing is for educational and entertainment purposes only. This is why I always stress so very much that you got to do the best thing that you can do for your portfolio, for your family, because you are the one who is stuck with it at the end of the day, just like I'm stuck with mine. So I don't make any of my trades or any of my decisions. There's a lot of people that I follow and respect on Twitter, but I don't make any trades based on their recommendations. Unless I see their recommendation, I go look at it and I go, I think that's a really good play, and I missed it because there's definitely people who will catch things that I don't catch. I'm not going to catch everything. I'm going to be wrong sometimes. Not every trade is going to be a home run or even green. Sometimes you're going to get stopped on trades. The goal is, though, of course, always you want way more winners than you got losers. Okay, when you have way more winners than losers with compounding interest, you're going to be all right. So do what's best for you. At the end of the day, do what's best for you. Don't listen to me. Don't listen to anybody else. Listen to you. I highly recommend, if you're married, consult with your significant other. Make sure you guys are on the same page. My wife knows about everything that I do, so it makes it easier. Life is not easy, but easier. And at the end of the day, that's what we're all chasing, right? So, a covered call. The one I want to talk about, and I love seeing, so if you haven't also already, follow me on Twitter, Colin_Gladman. I'm getting to the point where I have so many followers that I've also got lots of people trying to scam people out of money, crypto. I am never going to DM you about your trade or how it's going or try to siphon crypto out of you or anything along those lines. Please do not listen to that. Please do not fall for that. And if you see one of those accounts, please, just block it and report it. Feel free to tell me about it. I'll do the same. And also, too, I always try to answer as many questions that I can, but I'm not going to live my life on Twitter at the same time. So, sorry, this has been a long intro. Let's jump into what I want to talk about. So, let's see here. Where are we at? All right. So, shout out to Donkey Tonk Hero. He's been following me for a while, commenting on a lot of my stuff, and he was just mentioning to me how well he's doing with his trades. So he's actually so right here, let's just look at his tweet. So it says, "Love it, brother. I'm a rookie trader, but since he's buckled down and learned." So let's start with that. He's buckled down and learned. He didn't just go, "Colin, just spoon feed me plays," or anything like that. That's not what I want you to do. I'm not here to spoon feed you plays. I'm here to teach you so you can, it's like I tell my son all the time, I want my son to start learning how to think the way I do when I look at charts or anything like that, so he can make the trades. When he makes a trade every single week, I make him come to me with the plays that he wants, and then we talk through it about what might be good or bad or anything like that. But he buckled down and learned. Since then, he's grown his AMC position from 201 shares to 500. So he's 2.5 times his position in AMC. I don't care if you like AMC or not. It's a play that he believes in, and he's 2.5 times his position. Not with his own money, with the premiums that he's collected through selling covered calls. It's beautiful. I absolutely love this. And he's gone from only being able to do 2 contracts to 5 contracts now. And he literally puts, it feels like free money. And I agree. It blows my mind that more people don't do this. So a covered call is where you place 100 of your shares up for sale, essentially. Not essentially. That's what you're doing, okay? So you pick, just like regular options, you pick the price that you're willing to sell the share. You pick the date that you're willing to sell your shares at. And so like someone was asking me on Twitter today, and they were like, well, I've got this covered call at this time. Do I lose my shares today? And the answer is no. You don't lose your shares today. The only way you lose your shares if by Friday, that whatever Friday expiration you picked, if the stock price is above that level, then yes, you would lose your shares at that point in time. But there's a lot of ways to hedge against that. You can use your premiums to buy shares. You can use your premiums to buy calls at the exact same strike price that you might potentially lose your shares at. So real quickly, just throwing a dart out there. So let's say you did cover calls this week at $12 on AMC. And today we shot up to $14. And I actually think that's pretty close to what that person was asking me about. They were like, do I lose my shares today? And I'm like, no. Well, number one, AMC closed the day at like 11 something. But number two, it's not Friday. It's not your expiration date. It's not like as soon as it went past, that strike price, it's not like your shares automatically get called away. It's not like the contract that you sold that person can then, exercise and take your shares right at that moment that it goes to 14. That's not how it works. It's got to be on your expiration date. So that's why you pick your expiration date. There's also options to roll these contracts out. I'm really not going to get into all that. Like I said, there are lots of ways to avoid, the big thing everybody's concerned about is, these are my buy and hold shares. I don't lose shares. I only get more shares. And there's lots of ways to hedge against losing your shares. If you lose your shares, with all due respect, it's 100% your fault, not understanding the strategy correctly. So be like Stonky Tonk Hero, learn this stuff. So let's see here, where were we? Oh yeah, so BBIG. So this is going to be, not going to let me make it big. So this is going to be the contracts that I did for BBIG this week. So I believe it was on, let's go to the chart a little bit. So it was on either Monday or Tuesday. I think it was Tuesday actually. So on Tuesday of this week, I sold 75 contracts for BBIG. So once again, each contract is 100 shares. Okay, so 75 contracts means I'm leveraging 7,500 shares of BBIG. Now, once again, you do what's best for you. The way that I do it, because I own, in my swing account, I own a lot of stocks that in this type of volatile market can see big price changes. So the way that I play it is I have my overall position, okay? And just to let you guys know, I'll just tell you, so I have 20,000 shares of BBIG. So the way that I do my position, or I decide on my covered calls, is even when I sell covered calls, I don't think between like BBIG, Mullen, AMC, GME, or anything like that, I have never risked all my shares, because the reality is we never know when we're going to wake up to, like this morning where AMC went from like, what did it go from, like $9 and I think like 70 cents was its low, all the way up to over $14. We just never know when all of a sudden we're going to see those big spurts of volume or anything like that. I feel like I have a pretty good idea of when we see stuff like that going on. Like I said, right as Power Hour started, I was like, this is where we're going to see more volume coming in. We're going to get a price push up. It's exactly what happened. So I have a good idea, but I would be lying if I said I thought we would go from $9.70 to $14 a share in an hour this morning. So you never know when stuff like that's going to happen. So that's why you always got to have what I call the moon bag, okay? Like I said, I usually started around like 30% of my overall position. If I think the week is going to be bad, or if I think it's kind of looking ugly, then I'll do more of my position. For instance, right here with BBIG, I did a little bit more than 30% because I just didn't see it mooning this week. I really think that we're going to have, up until next week. I think May 18th is going to be our record date. Then like May 27th is distribution date. So those are kind of the dates that I'm looking for. So probably next week, especially if we start seeing volume coming in. And I tweeted out earlier, BBIG was already, let me double check, see what it closed at. So if you were following me, I used the dip today to close out all of my covered calls on all my positions because, yeah, BBIG went up 9.13% after hours today. That's a big move after hours. So in total, it went up 15% today. It's a great day. So I closed out all of these contracts today. It cost me, $2 a contract or whatever. That's fine. And so in total, on this, I made $513. Well, $513 can go to my dry powder. It can go to buying more shares. If you were in a financial pinch and needed a bill to pay, you could use that for that. Once again, you need to do what's best for you. For me, my money stays in my account. My son and I, we call it our snowball. And all we want to do is every single week, every single month, we want that snowball, getting bigger and bigger and bigger. The more money you have in your account, the more contracts you can sell, the more stocks that you can buy, the more money you can make. So you want that snowball to get bigger and bigger and bigger. Also, you introduce, different tax consequences and things of that nature. So don't pull the money out unless you absolutely have to, would be my recommendation, but you do you. So when it comes to your premiums that you're collecting, like I said, the most common thing that I do is I either purchase more shares. If I don't like the price that it's at, then I just leave it as available money to me. Also, too, another thing that I highly recommend that I want to talk about here is do not, if you never have an available balance of money in your account that you can buy stocks at, you are over leveraging yourself, in my opinion. Don't ever go, oh, this is the absolute bottom. I got a full port into this one stock or this one play or anything along those lines. You need to always have available money so you can close your contracts when you need to. For instance, if I see AMC really starting to spike and it's starting to get too close, to my contract, like I've definitely closed out contracts before when they slightly got in the red when I was wrong before. But you need to have dry powder available to do that. So you need to have at a minimum, and at the end of the day, think of it as kind of like your emergency fund for life. All right. So, I'm a firm believer and you need to have a massive emergency fund. Anywhere between 3 to 6 months of expenses is the general rule. You need to have that same thing in your portfolio. So I always have several thousands, actually several tens of thousands of dollars available to close out contracts as I need to make the dry powder bigger. And if you hear me say numbers like that and you get sad and depressed and I'm never going to be able to do that, you got to turn that, I call it your internal child. You got to turn that internal child off. And it's just, once again, I always tell my students it's not there yet. So it's like if I can't do that takedown, it's just because I can't do it yet. If I can't throw that head kick, it's just because I can't do it yet. If you've got a small account, it's just because you don't have a big account yet. You got to work for it. You got to grind for it. It's not going to happen overnight. That's why I'm not a YOLOer. I'm building my account over a long period of time. That's my plan. So if you like risky stuff, you're probably not going to like too much of this. So when it came down to BBIG, what I wanted to see is based off my TA is I wanted to see what happened and how we responded to, this top touch right here. And then this morning, what I was looking at, to add more shares, depending on how it respected the bottom of this upturn that we have, or we've got this massive, I'll zoom out a little bit more, go to the 1 day. Every single time BBIG comes down here and gets in that $2.15 area, there's almost always a big reaction that happens at that point in time. So we came down here and we retested. So I actually might have opened these once I saw this move right here. So I might have done it on Wednesday. I'd have to go back and double check. I apologize on that. But once we started, trending down with the overall market getting its teeth kicked in, it was pretty obvious we were going to test the breakout. We did, had a decent reaction to it, but the volume didn't really come in when we did. So I anticipated coming down here, at least testing this trend or this trend. So the first place I was thinking about buying again was about 229. The next place would be, of course, right around that 215 area. So I got pretty bearish here, and that's when I decided to open up those covered calls. You can always check the price. I recommend Option Strat. You can always come in here and check the price. You can pick, so right here, you just go up to the top and it says build. You can also download this as an app on your phone. I do it all the time. Look at it there as well. You go to build and you come over here and where it says income. Whoops. You come over here where it says income. There's a covered call selection. You just click on that. You enter the stock up here. So we're on BBIG. And here's your expiration date. Tells you how many days away. And then it gives you all your stats. It tells you how much premium you're going to collect, how much your max loss is, how much your max profit is, and it tells you where the stock price needs to be where you would break even. So if it went past your strike price and you were in danger of losing your shares, it shows you your break even at that point in time. So for instance, like looking at May 20th, full disclosure, I won't be selling cover calls more than likely on BBIG this next week because of all the catalysts that are going to be starting to come in. I think BBIG could see a decent week next week. So, but we'll see how, what the market does, all that good stuff. And then you just click here and you slide to whatever price you want to do it at. Okay. So there's 3 types of contracts when you do this, my friends. You've got out of the money. So if I go up here, like in the 350s, anything above that, and then you got slightly out of the money and you got way out of the money. The further out of the money that you go, the less premium you're going to collect. So for instance, May 20th, next Friday, a 450 contract on BBIG is going to pay you $13. So you would make $13 for every 100 shares you were willing to do that. Now, BBIG's current price, $2.63. You would also make all the money from $2.63 to $4.50. You would make all that money from $2.63 to $4.50. Now, if it goes over $4.50, you would not make that money. That money would go to the person who purchased your contract. So you put your contract out for sale. You were like, hey, internet, here's 100 shares of BBIG. I'm willing to sell them on May the 20th at $4.50 a share. So essentially, how much is that? 100 shares, $4.50 a share. That's $4,500 for you. So I'm willing, if you will buy them from me at that price, then a buyer will go, hey, I like that contract. And for that, I'm willing to pay you a premium for the option to that contract. That's where the $13 is. So a buyer would come say, you know what, that may not be likely, so I'm only going to give you $13 for that contract. You know what? $13 a deal. If your contract goes over $4.50, then your shares are going to get called away. That's why it's called a covered call. Your shares are going to get called away out of your account at the price that you agreed to sell it at. So if BBIG was $6 at the end of the week, your shares are getting called away at $4.50. And the guy who paid you $13 for the option to that contract, he's going to get everything from $4.50 to $6. So he's going to get that $1.50 gain right there. So that's how you have to think of it. Okay. The closer you get to slightly out of the money, so let's say $3 a share. So now that premium almost doubled. It went from $14 to $25. So now you say, hey, buddy, I got another 100 shares at $3 that I'm willing to do. And that guy will say, you know what? I'll give you $25 for that contract. No matter what happens, you get to keep the premium. That premium, the second you sell it, the second your order is filled, then that premium goes directly into your account immediately. Depending on the brokerage, I don't know exactly when it's available to you. For me, with Fidelity, I do so much and money that's in there and everything like that. All my premiums are available for me immediately. So as the second I sell the covered call, it immediately shows up as an available credit in my account that I can transfer out of, buy stocks with, do whatever I want to do with it. And like I said, probably 9 times out of 10, it just sits there. Okay. Now that's money I will use to buy shares on down the road. But once again, you got to make the decision that is best for you on that. So that's what we're looking at strike-wise. So at the end of the day, the way I do it, I have never, in all the time that I've been doing this, I have never sold a covered call contract further than a week out. Because in my swing account, I play a lot of stocks that are going to be a lot more volatile. So I'm not just going to go, okay, let me go to June 10th at $3. Oh, it'll pay me $38. I like that. You know, I mean, I personally don't do that at all. I play weeklies. Now, here's the next big thing that people were asking me about. When I posted on Twitter today. Where did I put it? Okay, so this person, quick question on financial advice. So if you sell the call, the value goes down, then you can close your contract out using the money from the premium and pocket the difference and don't risk the 100 shares you put up for the covered call in the first place. And I quote tweeted him and said, yes, and this is exactly how I use them. So let's talk about that now. How do you get out of them? Okay, you entered into the contract. Also, too, guys, when you go to whenever you go to sell your calls, it's sell to open. You're opening a new contract. You are selling a contract, hoping to get a buyer on the other end. And, obviously, those pretty much autofill if you do them at, market prices. You can do it at limit prices. You can enter in whatever you want. And that's what I also recommend. You're going to have, your bid in your mid and the ask. And so you got to make sure, pay attention to how your order is going to get filled. So especially if you don't have to do a lot of them, like obviously, once again, I did 75 contracts this week. So, it was like, I don't really have time to sit there and, I'm not going to get nickel and dime over like $50 because of the amount of trades and the amount of money that was involved with it. So I just, did a market order. But you can set limit orders, and the smaller your account is, and if you can only do a few amount of contracts, I would recommend making sure, get good prices on the contracts that you do. So, but when you're going to sell to open, you pick your expiration date and you pick your strike price. All right. Where is that? I know it already. Bro, where is it? I'm sorry, my friends. Give me 1 second here. Ah, there we go. So, everything went spiking out of control. So I had AMC contracts and everything like that going on. We're going to go 15-minute here. So once we had this spike and we had this big dip right here, I felt quite confident we would see it pick back up towards the end of the day. Look at that, volume increase, like I said it was going to. But we had this big drop, so I used this opportunity to get out of all of my covered calls. So when you see those big, spikes in price or anything like that, just calm down. Watch. Let's go here. Let's look at the RSI real quick. Guarantee it was getting super hot. Look at that. So no stress. Even I'm going to get some type of cool off here before it starts ramping back up. That's just the way the stocks work, my friends. So once I saw the RSI cooling off, for bullish indicators, once that RSI starts getting back into like that 50 range, that neutral territory, that's when you want to see it start to curl back up for bullish momentum to continue. So once I got down here, we started seeing a little bit of a curl up. I used that as the opportunity to get out of any and all my covered calls because I was, like I already said, I was surprised by this move. So I didn't want to get trapped if we came back down, cooled off a little bit, and then boom, started shooting back up here. Because the covered calls that I sold this week, I think we're at 16. Yeah, they were at 16. So, if we had another, come down, another big push up, all of a sudden I'm looking at like, dang. So when you buy out of those covered calls, they're going to fluctuate like you do with regular options. Every little, price matters how much it costs you to get out of your contract. So once I had this big dip right here, all my GME, AMC, BBIG, all of my big covered calls that I was playing, all those dropped to like $1 or $2 to close out of those contracts. So boom, you pay that. You buy to close. So you sell to open. When you want out of your contract, you buy to close because you're going to close out of it. Now, in its most simple form. And like I said, so some people, like I said, he was asking me like can people, selling covered calls that lost their shares on that run? So it's just like, it felt like there was, like I said, to me, it just felt like there was a lot of people really confused. So that's a big reason I jumped in here and made this video. So you can buy out of those contracts at any point in time, before your expiration date. It's only if you let them expire and that contract is in the money are you going to lose your shares at that point in time. So like I said, you can roll them. You can buy calls at the exact same strike price that you're going to lose those shares at, and you can exercise those. I mean, there's lots of different options. I only would let my shares just go away if I was fine with just letting those shares go away at that price. I've made a lot of trades like that. It's just like, okay, you know what? I'm okay if I back off my position a little bit, because I think there might be a pullback where I can buy lower or anything along those lines. Honestly, I've definitely done that with AMC before. I've lost shares. If you've watched my videos, I've said I've let my shares go 2 times and was able to buy back those shares and more when the price dropped. Okay, so not every time, but there's definitely going to be certain instances where I'm okay if I let my shares go. Now, let's see here. So when you get out of a contract, so there's sometimes where I've opened up my covered calls. So hypothetically here, let's say I opened up my honestly, I did it on AMC this week. So let's just use AMC as an example. Sorry, I know I said I was going to use BBIG and I know I'm not. So I bought calls on AMC going into earnings, like I talked about. And then I sold covered calls based off of the gap fill. So, and then I was waiting to see, what was going to happen. AMC just kind of kept tanking. So I just kind of rode those out, let Theta do its thing. So when you buy calls, Theta is your enemy. When you're selling covered calls, then Theta is your time is your friend at that point in time, because the more time that passes, the more premium that you're going to collect. But if you ever get nervous, or if you ever go like, you know what, I've made 50% on this contract and I really like 50%. I mean, my example that I just had up here is like BBIG's contract. When I closed it out, I was like at 77%. I'm good with that. Not everything's got to be 100% home run or anything along those lines. Once you get happy, once you're like, man, that was a good trade, that's when you should consider closing things out. I guarantee, if I didn't close out my BBIG trades and now that contract would be way more expensive for me to close out in the morning, now at $2.90. So like I said, these are the things that you got to think of. You don't just have to buy something and write it out. If it's looking ugly, get out of it. But only do it with a certain percentage of your shares that you, worst case scenario, would be willing to lose. And like I said, when I say willing to lose, like I said, you can always go back and buy calls at that strike price that are in the money and then exercise them. So there's just not, in my opinion, which is all this channel is, and you get to listen to it. In my opinion, there's just not a reason to not be doing this on your positions and acquiring new shares. Once again, shout out to Stonky Talk Hero. Be like him. Or I guess her. My guess is it's a him. But, be like him. He loves AMC, and he's grown his position by 2.5 times in a short period of time. So from the run of 34, so like 6 to 7 weeks ago, my man has doubled his position because he was selling covered calls and he was being a wise investor and a wise trader. And that's all I want you guys to do. I never plan out my videos. I know this video might have been a little bit all over the place. Please don't hesitate to ask. I'm, like I said on my tweet, I'm not going to sit here and hold your hand or anything along those lines. With all due respect, you guys aren't paying me anything. I'm not going to sit here and handhold your trade, and I don't want you to handhold your trade. What I want is for you to become educated, and where even if you still want my advice on what you might want to do, you can start seeing the trades for yourself. That's the ultimate goal. So be good. Let's see what's going to happen the rest of this week. Once again, like, subscribe, share, do your thing. Help the channel grow, and no financial advice. Do what's best for you and your portfolio. Don't just listen to me. Don't listen to anybody else. Definitely don't listen to some of these clowns on the internet who have no idea what they're talking about. It's one thing to be like, listen, that's not the plan for me. I want to just buy puts instead of selling covered calls or anything like that. That's all great. People can have different plans. I'm fine with having different plans. But people who just say, no, that's wrong, you're stupid, you don't know what you're talking, those people are bonkers. Don't listen to those people. You want to be successful? Do what successful people do. Don't do what people who have no idea what they're talking about are doing. You want to be skinny and in shape? You got to do what skinny and in shape people do. Not listening to the dude at McDonald's that weighs 400 pounds. Just my 2 cents. Do what's best for you. I'll catch you guys on the next video.